Rule number 8, and this one is like he really likes this quote. I think Dr. Crosby, he was like, "This is so facts. Many shall be restored that are now fallen, and many shall fall that are now in honor." So rule number 8 is excess is never permanent. Simply meaning that when things are going really well, it's probably going to come down. When things are really bad, it's probably going to go up. Pretty simple. But this idea, in a more in the term of psychology or whatever profession it is, it's regression towards mediocrity. Ben brought this up a bit earlier. It's just simply saying that like we tend to just go towards average. And he brought up a lot of great examples with sports. Like when someone has like a great game, they might the next day have a bad game, right? But this is just because like it's the rule of average. You're always going to come back to where you really are for like consistency, I guess, right? So if you're normally in the basketball sense, if you're average normally 20 points a game and you have a 40-point game, you shouldn't expect that person to keep having 40-point games. There might have a 10-point game and it's all going to balance out, right? And so this is the same thing with the stock market, that stocks might be doing really, really well, but they might still have potential in the future. But there's things like we mentioned before, like corrections. And so you should expect a correction to happen, and you should expect that in the long term, you're going to understand the average, but in the short term, the excess, the excitement, or the bear market is not going to last forever. And a quote that he just loves saying is, "This too shall pass." So always think, this too shall pass. Everyone's super excited about crypto, blah, blah, blah. Crypto itself, the technology, is what you want to add, is not going to pass, but the speculation and the amount of money that people are throwing at it because they don't really understand yet is going to pass, and eventually you'll see the real winners. So
right,
that is rule number 8. But rule number 9 is super uber important, and if you could break this down for us, Ben.
Yeah, there's a couple things to understand. The uber rich, so people like Elon, Warren Buffett, Mark Zuckerberg, the insane rich, a lot of times they are not very well diversified. And so rule number 9 is diversification means always having to say you're sorry. And he's advocating for diversification. But he points out that the uber rich aren't well diversified, but that's because the uber rich are on the same side of the coin of the uber poor, or on the side of the coin of the uber poor, and that most people who are not well diversified are poor, right? And that only a small percentage, a small sliver of those who put all their eggs in one basket, if that basket goes crazy, if it goes, they win the lottery, they become super rich. And so the takeaway here is not necessarily that, that you shouldn't, it's not really about the rich and the poor. The real takeaway is this idea called variance drain. And so we often look for very high returns, and we're often looking for, we think that if we can get 100% return, that's really good. But it's not just about your return in 1 year. It's about your returns throughout your long-term investment. And so what variance drain is, well, I feel like you can explain this better, actually, because I know you really wanted to hit this topic.
Oh, yeah. So variance drain. So this straight up just the definition that Dr. Crosby says is determine. How do you say that word? I'm bad at pronouncing things.
Detrimental.
Yeah. The detrimental effect of compounding wealth off of lower lows when investing in a highly volatile manner, right? So like, what does this mean? What is lower lows? So essentially what he's saying is that if you are picking stocks or something that is like, if you're picking stocks that are, I guess, volatile, right? And so 1 year the stock does really bad and it goes down like 20% or whatever, and it's valued less, but then the next year it goes up 40%, right? But in actuality, your long-term returns won't be as great as if you picked a stock that was consistent. And the reason why is because compound interest, the way it works is the amount of money you have in a return. So you have, let's say, $100. You invest something that has $100, and then it goes down to it goes down by 10%, right? So now you have $90, but then the next year it goes up by pick something simple, 10% again, right? Let's say it goes 10%, just because I don't want to do quick math on my head like that, but it goes up by 10%, right? And so now you're back up to what, $99, right? Mm-hmm. So, but if you pick a stock that was more not less volatile, you would have it, so it goes up by an average of like 10, right? It's just 10%. It goes up 10, so then you have $110 after that first year, but then the second year it compounds on 110. So what's important here is to understand what are you compounding on? Like, you don't want to compound on lower numbers, even though the average return might be the same. You want to be compounding on higher numbers, if that makes sense. I hope I was able to explain that. But I think a good way to put it, to not stress this topic enough, is that it takes 100% gain to recoup from a 50% loss. So how I mentioned that if you lose 10%, but then you gain 10% again,
you lost money.
People think like, oh, wouldn't that even it out? Because
No.
you had 100, but then now you lost $10, but then you try to compound on 90. 90 is not 100, so you only get $9 back, and you've lost 1%.
Yeah, because you lost 10% of 100, but then you only gained 10% of 90, so you lost $1 there.
Simply well put. But so we're talking about volatility, and it's like, okay, well, isn't that bad then? No.
Well, it's complicated.
It's a bit complicated. So rule number 10, the final rule is risk is not a squiggly line. A hilarious way to put it, but volatility is not risk. And I am so happy he had brought this up. Oh my.
It's such a crucial point because I took a finance class over the summer and they defined risk as volatility. So when he said this, I was like, yeah, I'm glad they said this, because in the class I was like, that doesn't really make sense to me. But my teacher didn't think I was right at all, so I just went with it. But keep going, Mel.
And the reason why a lot of traditional schools and, finance people will say risk is volatility is because it's an easy way for them to calculate. It's an easy metric. People want to throw math and, again, fancy models and everything like that to it. But to think that risk is volatility is the same idea to think, and this was a great example from Nassim Taleb, and he says, so for anyone that doesn't understand volatility, that is like the price of something fluctuating a lot. So one day it might be up 10%, might be down 20, might be up 100, might be down 200, and all that. It's just fluctuating a lot. That amount of volatility, the 100, that's not good. You don't want that. But in general, you get the idea. So what he says with volatility is that, so imagine that someone that's working, like a husband or whatever, he comes back home at 6 o'clock precisely, right? So this is related to a stock that is not volatile, that is pretty consistent. So the stock goes up, let's say it doesn't swing a lot. It has a natural growth of like 2% or whatever, 5%, right? But compare that to a husband that comes back around 6 o'clock, so maybe 5:30, 6:30, right? But when there's a change in the stock that is constant, like when that husband coming back at 6 o'clock just doesn't come back at that exact time, maybe he comes a little like 5 minutes late, 10 minutes late, something, not a lot of time difference, but it makes you worry, right? And so the idea with the stock is when you have something that's not volatile, you tend to immediately get emotional, immediately make irrational decisions when you see a change, because you're like, oh, well, like, what's happening? Like, da-da-da. But then when it comes to a volatile stock or something that is, let's say by definition, less volatile, more volatile, like if the husband comes back at like 6:05, he comes back at 6:20, or he comes early at like 5:20, that is to be expected. You've already ingrained that idea, like that is to be expected. But this has more to do with different asset classes, right? So when I'm talking about the less volatile, I'm talking about something like what he calls like bonds and different type of like bonds. What bonds are like government debt. So they're saying like, hey, this is debt, we'll pay you back a set interest rate, right? And that's less volatile. But the reason why he talks about volatility is saying like, if you just decide like, hey, I want the less volatile thing, what you're doing is you're having a trade-off, saying, okay, you want less volatility, you're gonna get less returns overall, right? And so the idea is that the stock market is just more volatile than a lot of other asset classes, because you can find things like bonds, again, gold, where you're not really getting much appreciation, but the price of it's staying constant. But again, we're trying to beat inflation. This is the idea that the reason why you invest is you're trying to beat inflation. So you take the risk of, or perceived risk of doing the stock market, it's more volatile. But the thing is, again, thinking long term, you understand that volatility averages out to about a 7% return after you account for inflation and things like that. So again, simply put, volatility is not risk. The real risk comes from understanding the company. So if something in the company changes, that's what's important. Looking at the price of an asset is not going to tell you the important information. That is not how you should assess a company. And specifically understanding that when you're investing in a company, you're investing in you're investing in a company. You
Yeah.
own a part of that company, so you should be worried about what the company's doing and not what people are thinking the company's going to do, because that price itself is just a reflection of people's speculation or people's theories. But what the company's actually doing is the foundation to why people are investing in it. So again, just understanding that is super important. And I wanted to tie this into Bitcoin. You guys should have seen this coming. Bitcoin is volatile. Yes, duh. What has it been doing? Appreciating up in the long term, right? But to give a better argument for it is to say that if you understand that Bitcoin is not an investment, Bitcoin is more of gold. Bitcoin is not in itself. It's a different asset class in itself, meaning that I wanna pick my words carefully here, because I don't want to have people wanting to just go off and invest in Bitcoin. Do your own research. But if you understand like the differences of why people invest in Bitcoin, that it's not just a speculation, and that you understand that the volatility is a result of the technology being new, and you think long term, and if you believe that Bitcoin will be the standard, that governments, people will save in Bitcoin, will use that as money because it cannot be violated, it cannot be inflated away, then you understand that the volatility in Bitcoin is not a risk. And if you're only looking at the volatility of Bitcoin, you're giving up on the upside of what it could be in the future. So again, invest in things because you understand, but don't look at the price as a metric for you to decide whether you want to invest. That was a long rant.
Real quick, just another way to look at this is if a stock is steadily trending downward, but very steadily, because it's steady, we would define, people would define the risk as being low, right? But if it's trending downwards, it's a risky stock because it's not like let's say Blockbuster back in the, before Netflix came along.
Mm-hmm.
It was very, if it has a very low volatility where it's going at the same pace, but it's trending downward, and Netflix is taking over, its risk is not in its lack of volatility. Its risk is in the fact that the company is about to go bankrupt from Netflix, right? And in the same vein, if a company is highly volatile, but over a course of 5 or 10 years, its growth is very high despite its volatility, the risk is not in the volatility of the asset. The risk is in the value of the company. In this case, because the company is sound, even though it's volatile, it's a low risk because it's a good company underlying the stock. Okay,
that's a great example. The risk is in the incompetency of the company. So I just wanted to use that word. But with all that being said, knowledge isn't enough to succeed in investing. This is a direct quote from Dr. Crosby. You must use a strategy and set up a system to control your emotions and allow you to use your knowledge effectively. So this is what we'll talk about more in the second part of the Laws of Wealth summary.